What's happening, everybody? Pete Olinto with you, and you are now officially on your way to a CPA, or at least passing the financial section. This is kind of like our first date. This is very exciting. Our first topic together. You know, someday when you're a big-time CPA, you'll look back on this day and say, man, am I glad that's over with. All right, so here we go. Let's talk about the primary financial statements. What do we need to have general purpose financial reporting? What is a full set of financial statements? Well, it includes your balance sheet, your income statement, your statement of something called comprehensive income, a statement of cash flow, a statement of owner's equity, and also the notes to the financial statements. So you need to know what is the definition of general purpose financial reporting. You need a full set of financial statements that includes everything I just described, as well as the notes, because the notes are going to describe the methods of accounting that were chosen by management and the estimates. So the user of the financial can understand, is there any management bias? All right, so let's start with two names. It's either the balance sheet, or you can call it a statement of financial position. That's going to help us determine the financial risk if we invest in this company. We look at their balance sheet, and we can determine what their liquidity is, that short-term risk of distress. We could also look at the balance sheet to determine the capital structure, the solvency, the use of debt or equity. The long-term financial risk, again, is called solvency. And, you could also look at the balance sheet to determine growth potential, the size of the assets. You need to do a little trend analysis, but there's a correlation between the size of the inventory and/or the PP&E and the generation of sales. If assets go up, you would think sales would go up. If assets are going down, you would think sales are going down. So it helps us determine financial risk and potentially growth. Okay, second financial statement we need is a statement of earnings, commonly known as the income statement or the P&L. It's going to help us determine the performance. Were they able to turn those assets into revenue? Could the revenue create profit? So it helps us determine that performance, as well as operating risk. As you look at your sales over time, you want to calculate your average sales and then the standard deviation around the sales, the volatility. You want to look at your operating income and then the volatility, the standard deviation of that operating income. So it helps us determine performance as well as operating risk. Now, unfortunately, not all gains and losses go on the income statement. For whatever reason, both U.S. GAAP as well as International Financial Reporting Standards, certain gains and losses are not going to immediately go on the income statement. They first go to what's called direct to equity or other comprehensive income. So whenever you hear about a gain or loss going direct to equity, that means instead of going on the income statement, then into retained earnings, and then into equity, no, instead, it's going direct to equity. If it's good news, it'll make equity go up. If it's bad news, it'll make equity go down. The definition of comprehensive income, with the emphasis on comprehensive, that's the sum of two things. The sum of net income per your income statement, the 99% of your revenues, expenses, gains, and losses that went on the income statement, then retained earnings into equity, plus the few transactions that have been carved out that for whatever reason GAAP does not want on the income statement yet. They go direct to equity. So that's called OCI, other comprehensive income that year. So comprehensive income in any particular year is the sum of two pieces. The net income per the income statement plus the gains and losses that went direct to equity. And what's that called? OCI, other comprehensive income. Tell me that again and I'm going to poke you in the eye. All right. We also need a statement of cash flow. Why? Because I need to know why cash changed. Cash going up might be a good sign if you're earning it. Cash going up may actually be an early warning red flag if you have to sell off your assets to generate cash to pay your bills. So I need to know why cash is changing. I also want to know the quality of my earnings. We're going to review the statement of cash flow, but ultimately one of the major differences between net income per the income statement versus the change in cash, your operating cash flow, is timing. When you record revenues and expenses, we're not cash basis. But the statement of cash flow is obviously cash in, cash out, cash basis. So it reconciles why the income per the income statement is different from the change in cash or the operating cash flow that you're generating from your core business. Look, if your income is going up, if your accrual basis income year after year is going up, but I don't ever see the cash being generated, that's going to get me nervous. Low quality of earnings. I think you're over accruing for revenue or under accruing for expenses. So statement of cash flow helps us to understand why cash changed, the quality of those earnings, and even risk. Can you generate cash from your core business? You see, if cash is going up, I'm not necessarily impressed if you're borrowing it or adding partners, because then you're going to dilute my earnings per share. But I'm very impressed if cash goes up because you're getting it from your core business. That's from your operations. So if you could generate cash from your core business quickly, well, there's less risk. And then growth potential. We look at something called cash flow from investing. Are you buying non-current assets, growing the business, or are you selling off your non-current assets, downsizing? And ultimately, a lot of analysts on Wall Street use a valuation model that depends upon the free cash flow generated to the firm or the equity. To make your calculation of estimated value using a free cash flow valuation model, the starting point for most of those valuation models is cash flow from operations. So really, the statement of cash flow is the most objective financial. Therefore, that's going to pretty much dictate value. Okay, not only do we need the statement of cash flow, but we also need the statement of owner's equity. A balance sheet will tell you owner's equity. A balance sheet from last year will show you last year's amount and this year's amount. But I want to see why equity changed. Just like the statement of cash flow. I don't need a statement of cash flow to see change in cash. I can look at last year's cash, this year's cash, and see the cash changed. I need the detail. Why did cash change? Why did stockholders' equity change? If stockholders' equity went up because you're adding partners, I'm not impressed. But if stockholders' equity went up because you earned capital that year, I'm very impressed. So the statement of owner's equity, why stockholders' equity changed. Is it due to a change in paid-in capital? You issued more stock, issue more preferred shares or common shares, or maybe equity went up because we had a positive change in retained earnings. You had a big net income that year. Or maybe you had a big change in your accumulated other comprehensive income. You had a lot of gains that year that went direct to equity. It's still a gain, even though it's not on the income statement. I like gains, right? They make my earnings go up. They make my equity go up. Okay. Lastly, before we cover anything else, remember the notes to the financials. Whenever you use accrual basis system of accounting, a good financial analyst doesn't do anything with that information until they understand how management calculated those amounts. Did they use LIFO, FIFO, straight line, accelerated depreciation? So it's very important we understand the methods and the estimates. So the notes, yes, are part of a full set of financial statements. Okay, we got to include the notes. That's part of that general purpose financial reporting. Now, there's something called a classified balance sheet. We will show the world current and non-current assets. We will distinguish those. We will show current and non-current liabilities. We'll distinguish that. A balance sheet could even be based upon liquidity. Okay, that's also permissible. Here's an example of a classified balance sheet for you. Notice, first of all, the name of the company, the name of the financial statement, and then the balance sheet is cumulative. It's all the assets and liabilities we've accumulated as of a particular date. What are we doing with the balance sheet? Not directly valuing the company. Why? Because most assets are not on the books at fair market value. Under US GAAP, most of the assets are on the books at historical cost or net book value. It's not generally going to be marked to fair market value. So as a general rule, most of the time, you're not using a balance sheet to directly value that entity. But we're going to use the balance sheet to determine our required rate of return, or at least partially determine our discount rate for different valuation models by determining the financial risk of investing in this company. So I want to look at their current assets relative to their current liability to determine that short-term risk of distress, that liquidity. I also want to look at that balance sheet to determine, well, how did they raise their capital? What combination of debt and equity? That helps me determine long-term financial risk, solvency, the company's capital structure. I also want to look at how much of my assets are current versus non-current. Why? More current assets you have, the less risk of distress you have, but the downside of less risk, lower return. If you're hoarding a lot of assets in the form of cash or short-term CDs, you're not going to make a lot of money that way. So we want to look at the current as well as the non-current and what the changes are. Now, when it comes to your capital structure, you want to look at the debt versus the equity. There's pros and cons to different proportions of debt and equity, but you also want to scrutinize the equity. There's part of your equity that I mentioned earlier is contributed capital. Not very impressed when you issue shares of stock to raise capital because you're adding partners. You could be diluting my earnings per share if you're issuing common stock. If you're increasing your equity through your earned capital, the revenues, expenses, gains, and losses that flow through the income statement into retained earnings, I'm impressed. I'm even impressed with gains that go direct to equity. Even though they're not on the income statement, nonetheless, they make equity go up, and that's part of my earned capital. So we look at change in retained earnings, we look at our change in our accumulated other comprehensive income to look at the earned capital. And sometimes a company decides, never mind issuing stock, we're looking at our stock, we want to buy it back. We think our own stock's a great investment. That's contra equity. When you buy back your own stock, that's not an investment. We know that's treasury stock. That's contra equity. And that could be a sign of optimism when a company buys back their own stock. They may think their stock price is undervalued. I'm not sure. But the balance sheet helps us determine financial risk, short-term risk, long-term risk, and growth potential. Are assets growing or are we selling them off and downsizing? Okay, so the purpose and the use of the balance sheet, short-term and long-term financial risk, as well as our capacity to produce, capacity to generate revenue. The more inventory you have, assuming there's demand for it, sales are up. The less inventory you have, well, chances are your sales aren't going to be as high as they used to be if you don't have much inventory. Okay, we also want a listing of our assets and liabilities, the type of assets and liabilities. Are they current? Are they long-term? For the assets, are they tangible? Are they intangible? All of these things are going to be important when assessing holistically the value of this company, the risk of making this investment. Now, specifically with valuation models, we need a required rate of return, a discount rate to apply to our valuation models. Well, part of the risk you assume when you buy a company stock is that they may not have the ability to pay their debts as they become due. That's financial risk. Short-term risk is liquidity. We look at things like the quick ratio, the current ratio. Long-term solvency, we look at things like debt to equity or the degree of financial leverage. That's part of your assessment of risk. Now, there's another type of risk called operating risk that we look at the income statement, your volatility in sales and earnings. This is financial risk. The balance sheet tells us the capital structure, right? How we raised our capital. One's not better than the other. Different proportions of debt and equity have different pros and cons. And if you play with the balance sheet formula and you subtract the liabilities from the assets, giving you the equity, well, that clearly shows you liabilities have the first claim on the assets. The equity has a residual interest. The stockholders don't get any capital back until the creditors get paid first. Okay, now what is an asset? It's a probable future economic benefit. In English, what's an asset? Something we think is likely to generate revenue in the future. Okay, so help us run our business to generate revenue. So assets could be classified in different ways, tangible or intangible, current or non-current. Your current assets are either cash or likely to be converted to cash within a year of the operating cycle, whichever is longer. You got things like your cash, receivables, prepaid, inventory, short-term investments. The more current assets you have, the more liquid you are, the less risk of distress. The downside of current assets that could hamper your return on assets because you don't get a big return on cash and marketable securities, etc. Non-current assets, well, we have things that like are investments, stocks and bonds we own in other companies. It's not directly used in our operations, okay? We either bought the real estate to generate rental income, or we bought other companies' stocks and bonds to generate dividend income or interest income or a capital gain. We also have PP&E. Very different than investments because PP&E is tangible. It's non-current, but we're using it in our business. We're using it to manufacture our product. Then we have things like intangibles. They're represented by a piece of paper. Now, these are used in our operations. We might have a patent, a copyright, a trademark, a franchise, a license. It's either a legal right or a contractual right most of the time with non-intangibles. The big issue with intangibles, many times the book value of the intangible could be well below the actual fair market value, especially if you internally developed that patent, that copyright, that trademark, as we'll see later. Okay, liabilities. We know they have a first claim on assets. It's a probable future sacrifice. It's got a maturity date. That's a big difference between debt and equity. Equity doesn't mature. Debt matures. You got to pay that bill someday, and are you going to have enough cash to service that debt when it becomes due? Current liabilities make me nervous because I got to have enough cash to service that debt when due. Current liabilities are mostly your operating liabilities. You owe money to your vendors, you owe money to your landlord, you owe money to your employees, whatever, your accruals, okay, your payables. Long-term liabilities are mostly interest-bearing. Mostly those are financing liabilities, okay? So your bonds, your long-term notes, etc. All right, so it's a way to raise capital. Now, equity is the difference between your assets and liabilities. They have the second claim on the assets, okay? Now, specifically, there could be different types of equity. Preferred stock has a preference to get a return of capital over common stock. So technically, creditors get paid first, then the preferred stockholders, then the common stockholders. But this capital was not earned, it was contributed. You could either borrow money and have to pay interest, but the good news is you're not adding partners. That won't dilute your earnings. Bad news with debt is, though, you got to pay the interest when due or you're rendered bankrupt. Or you can issue equity. The good news with equity, it buys you flexibility because dividends are not legally required. The bad news with a lot of equity, well, that'll dilute your return on that equity. Okay, then we've got earned capital. Very impressed when you can generate capital from your core business. That's this year's earnings that have accumulated. We're adding it to our beginning retained earnings. Then we'll pay out some dividends if we want. But bottom line is that's your retained earnings and what we call your accumulated other comprehensive income. It's all your earnings to date that have gone through the income statement or direct to equity that have not yet been paid out in the form of a dividend. That is earned capital. Very impressed when we can earn our capital. And then again, we have our treasury stock. Don't add it. We're going to subtract that. Shares held in treasury, our own shares, that reduces stockholders' equity. Okay, the major limitation of the balance sheet in the U.S., book value is not going to be equal to market value, not even close. Most assets are not marked to market value, and not even your liabilities represent the fair market value. Most of the time, the debt is recorded at book value. What do I mean by book value? Well, the bonds are recorded using the interest rate that was in existence when the debt was issued. So it uses the historical cost of borrowing to get the present value of that bond, that note payable. So balance sheet you're generally not using to get the fair market value, okay? Many assets are recorded at historical cost. Certainly that's less relevant, I get it. But the U.S. system takes the position that, you know what, when in doubt, let's make sure we got reliable information. So while book value may be less relevant, it's more reliable because an auditor can check an invoice to check to see what that price is. And you as the analyst, you're free to adjust from book to market value. So many assets, whether it be PP&E, book value is probably not going to equal the fair market value. The book value is skewed by the age of the asset, the amount of depreciation, internally developed intangibles. That book value is very little. It's probably just a legal fee to get the protection for that patent or copyright. The fair market value could be exponentially larger than the book value. Now, valuation methods are very important. We need to know what method is the company using, for example, for inventory. Are they using LIFO or FIFO? Because that will help the analyst, the user of the financial statement, understand why that value might be higher or lower relative to a competitor. So we need to know things like LIFO or FIFO. The method of depreciation. Are you using straight line? That'll probably give you a higher net book value for the asset in the early years because you're accumulating depreciation slower relative to another company that's using accelerated depreciation. They'll probably have a much lower net book value. Why are they going to have a lower net book value? Well, because if you accumulate depreciation faster, the higher the accumulated depreciation, the lower net book value. Not only do you need the methods of accounting, but we need to look at the estimates chosen by management. Things like the useful life for an asset. Okay, the longer the useful life, as you calculate, let's say, straight line depreciation or even double declining balance, the longer the useful life, the slower you will accumulate depreciation. That, again, will lead to a higher net book value. With assets your accounts receivable, we have allowances that are very important. Because we know or should know you're not going to collect 100% of your receivables. Some of that's going to be uncollectible. How is management estimating that allowance account, that bad debt? The lower the allowance account, the higher the net realizable value. So anytime management is choosing methods or estimates that lead to higher values for the assets or lower values for the liabilities, they're being relatively aggressive. Doesn't mean there's anything unethical or illegal, but just relatively speaking, given the choices they have, they're choosing methods, higher asset, lower liability, larger equity, or higher revenue, lower expense, higher profitability. So the financial analyst using those financial statements can understand it in the context of whether management is being relatively conservative or aggressive. So I know you're excited now. Isn't this stuff great? Aren't you so happy you chose to be an accounting major and you get to study for I kid you not. I learned more about accounting studying for the CPA exam than I did in all those years of accounting. For whatever, just like law school, all the years of law school is like one thing. But when I study for the bar, it kind of puts it all together. You're going to find that here. Make it interesting. Lie to yourself. Tell yourself you like this stuff. Convince yourself. Or be nuts like me and find it interesting. All right, guys, let's get off to a good start. One topic down, $4 billion to go. Slow and steady wins the race. We are on our way to a CPA. Who's better than us? Nobody. Let's go.